Is silver massively undervalued? New report exposes shocking truth. For over 50 years, one number has quietly ruled the precious metals market, a number central banks don't want you watching too closely. A new landmark study, analyzing 3,000 years of history and 56 years of daily pricing, just confirmed something most analysts got completely wrong. The old rules everyone believed were broken. They were never broken at all. And the gap between where silver is priced today and where the math says it should be is bigger than almost anyone is willing to admit. By the end of this video, you will understand exactly why. And what happens next could change everything. Welcome back to Currency Arc Insight, the channel built for serious investors who want the numbers behind the headlines, not the noise. If this is your first time here, hit subscribe so you don't miss the next economic warning before the market catches up to it. Drop a comment and let us know where in the world you're watching from today. For thousands of years, one number has quietly shaped how the world understood wealth. It was not a stock price, it was not a currency exchange rate, it was the gold to silver ratio, a simple measure of how many ounces of silver it takes to buy a single ounce of gold. And for most of human history, this number was not just tracked, it was law. In ancient Egypt, silver was so scarce that at times it traded almost equal to gold. Some records placed the ratio as low as 2.5 to 1. Later, under the Roman Empire, the relationship settled into something closer to 12 to 1, a level the empire enforced through its own currency system. Rulers understood something modern investors often forget. Gold and silver were not separate assets competing for attention. They were two halves of the same monetary system, bound together by law and by trust. That tradition continued for centuries. When the founding generation of the United States built its currency system, Alexander Hamilton fixed the ratio at 15 ounces of silver to 1 ounce of gold under the Coinage Act of 1792. For more than 100 years afterward, nations across the world anchored their money to some version of this same relationship. It was not viewed as a trading strategy. It was viewed as the foundation of sound money itself. Then, in the 20th century, everything began to change. Country after country abandoned fixed metal backing for their currencies. The final break came in 1971, when President Nixon closed the gold window and ended the direct convertibility of the US dollar into gold. For the first time in thousands of years, gold and silver were set free from government control. No law fixed their price, no treasury decided their value. The market alone would now decide. Many analysts assumed this was the end of the old relationship. Without a legal anchor holding them together, they believed gold and silver would begin to drift apart, moving further and further away from any historical pattern. Gold, they argued, would rise as the world's ultimate safe haven, purchased by central banks and wealthy investors, seeking protection from currency instability. Silver, meanwhile, would live a strange double life, half monetary metal, half industrial material, pulled in different directions by electronics manufacturers, solar panel producers, and speculative traders. Some analysts went further, declaring the ratio a relic of the past, with no real predictive power left. For decades, this became the dominant assumption. Financial commentators would casually dismiss the ratio as outdated. Newer generations of traders, armed with algorithms and derivatives, treated gold and silver as two entirely separate markets, each responding to its own set of forces. The idea that an ancient measurement from the age of Roman coins could still explain modern price behavior seemed almost absurd. But a strange thing kept happening. Every time the ratio stretched far from its historical range, it eventually snapped back. During major economic events, from the inflation panic of the early 1980s to the financial crisis years, to the extreme uncertainty of 2020, the ratio would spike to extraordinary levels and then reverse just as sharply. It was almost as if some invisible force kept pulling gold and silver back toward each other, no matter how far modern markets tried to push them apart. This pattern raised a serious question, one that most analysts avoided asking directly. Was this simply coincidence, random market noise that happened to repeat itself a few times by chance? Or was there something deeper still at work, a mathematical relationship that had survived the end of the gold standard, survived the rise of financial derivatives, and survived 50 years of modern trading? For years, this question remained mostly theoretical, debated in forums and repeated in passing by precious metals commentators without any serious statistical proof behind it. That changed when the Silver Institute, working alongside the research firm Precious Metals Insights, decided to test the theory properly. Using more than 3,000 years of historical reference points and 56 years of detailed daily pricing data stretching from 1970 to the middle of 2026, researchers set out to answer the question once and for all. What they found would challenge nearly everything the skeptics had been saying, and it would reveal a signal hiding in plain sight, one that has enormous implications for anyone holding physical silver, mining shares, or precious metals investments today. When the results of the new study were finally published, they did not read like an ordinary market report. They read like a verdict. The Silver Institute and Precious Metals Insights had set out to test whether the gold-to-silver ratio still meant anything in a world of algorithms, derivatives, and floating currencies. Their answer was direct. The ratio was very much alive, and it was behaving with more precision than almost anyone expected. The researchers began with a basic statistical question. Was the ratio simply wandering without direction, drifting wherever market noise happened to push it? This kind of movement is known in statistics as a random walk, a pattern with no anchor and no tendency to return to any particular level. If the ratio truly behaved this way, then history would offer no guide for the future, and anyone using it to predict silver's next move would essentially be guessing. The data told a different story. Using rigorous econometric testing across more than 50 years of daily pricing, the researchers found that the ratio was not random at all. It was mean reverting, meaning it consistently pulled back toward a long-term average, no matter how far it strayed. And they were able to calculate that average with striking precision. The equilibrium point sat at 59.8 to 1, a number close to 60, that had held steady as the true center of gravity for the entire modern floating era. This was not simply a theoretical curiosity. It meant that every time the ratio moved dramatically away from 60, whether shooting higher or plunging lower, it was not entering some new permanent normal. It was stretching away from its natural resting point, and history showed that stretched elastic bands eventually snap back. The report illustrated this with 3 defining moments in modern market history. During the precious metals mania of 1980, when inflation fears sent investors racing into hard assets, the ratio compressed dramatically, falling to somewhere between 16 and 17 to 1. Silver, in that period, outperformed gold by an extraordinary margin as investors chased the metal with more room to run. Then, during the bull run of 2011, a similar pattern repeated. As global uncertainty following the financial crisis pushed investors back into precious metals, the ratio compressed again, this time down to roughly 31 to 1. Once again, silver moved further and faster than gold, closing the gap that had built up in the years before. The most dramatic example came during the early days of the pandemic in 2020. As panic gripped global markets, the ratio spiked to an almost unbelievable extreme, reaching as high as 126 to 1. For a brief moment, silver appeared historically cheap compared to gold on a scale rarely seen in modern financial history. And true to the pattern, it did not stay there. The ratio reversed sharply in the following months, snapping back toward its long-term center as investment capital rotated back into silver. Perhaps the most surprising finding in the entire report challenged a popular assumption held by many modern traders. Many believed that as financial markets became more complex, with exchange-traded funds, futures contracts, and algorithmic trading systems dominating volume, gold and silver would naturally drift apart, each responding to its own separate set of forces. The data proved the opposite. Over the last 20 years, the correlation between gold and silver prices actually grew stronger, not weaker. Financialization did not break the bond between these two metals. It tightened it. This left researchers with a clear and confirmed conclusion. The gold-to-silver ratio was neither broken nor irrelevant. It was a real, statistically proven relationship, anchored near 60 to 1, that had survived the end of the gold standard, the rise of modern trading technology, and 50 years of economic upheaval. But this discovery immediately raised a new and far more urgent question. If the ratio always returns to its center, what was actually pushing it so far away from that center right now? The answer, according to the report, pointed directly at a force few everyday investors were watching closely enough. Every stretched elastic band needs a force pulling it away from its resting point. According to the new report, the current distance between the gold-to-silver ratio and its historical center of 59.8 to 1 is not a mystery. It has a clear and identifiable cause, and that cause is the behavior of the world's central banks. The researchers isolated 2 primary drivers behind long-term movements in the ratio. The first is the balance of above-ground bullion stock held between gold and silver. The second is the balance of investment demand flowing into each metal. Both of these forces, the report explained, are currently being shaped by the same institutional actor, and that actor is not buying silver at all. Over the past several years, central banks around the world have been purchasing physical gold at a pace not seen in modern history. This is not a new trend hidden from public view. Analysts covering precious metals markets have been tracking this shift since as early as 2022, watching central bank reserves grow month after month. The motivation behind this buying spree is not difficult to understand. Many nations have grown increasingly cautious about holding large reserves in a single foreign currency, particularly the US dollar. This cautious shift, often referred to as de-dollarization, has pushed central banks to diversify their reserves into an asset with thousands of years of trusted history, physical gold. The scale of this buying has been enormous, and it has had a direct effect on the above-ground stock ratio between the two metals. As central banks accumulate gold in record volumes, they are effectively locking large amounts of the metal away from the open market, held not for trading purposes, but for long-term national reserves. This steady, sustained demand has placed persistent upward pressure on gold prices, pulling the metal higher relative to silver. Silver, by comparison, has received almost none of this institutional attention. Central bank purchases of physical silver remain effectively at zero. There have been occasional reports suggesting that Russia's central bank may hold some strategic silver reserves. But even these amounts are considered minor compared to the scale of global gold buying. Other nations, including Saudi Arabia, have shown interest in silver through exchange-traded funds, but this is a very different form of exposure than holding the physical metal in reserve. It does not create the same kind of structural demand that has been driving gold higher. This imbalance, the report argues, is the single biggest reason the gold-to-silver ratio has been pushed above its long-term equilibrium in recent years. It is not that silver has become fundamentally less valuable. It is that gold has been receiving a wave of institutional buying that silver has simply not participated in. The result is an artificial widening of the gap between the two metals, one driven not by industrial fundamentals or investor sentiment, but by the specific reserve strategies of national governments. This finding matters enormously for how investors should interpret the current market. A wide ratio does not necessarily mean silver is broken or unwanted. It may simply mean that one very large and very deliberate buyer has been reshaping the gold side of the equation, while the silver side has continued to move largely on its own separate fundamentals: industrial demand, mine supply, and retail investment. The report is careful to point out that this distortion is not necessarily permanent. Central bank buying patterns can shift over time, influenced by changing geopolitical priorities, currency stability concerns, or simply a natural slowdown after years of aggressive accumulation. If that buying pace begins to ease even slightly, the primary force holding the ratio above its historical center could begin to fade. This raises the central question the report was ultimately built to answer. If the force pushing the ratio away from 60 to 1 is temporary rather than permanent, what happens when that force weakens? History, according to the researchers, offers a clear and specific answer, one with direct implications for anyone holding silver today. If the current gap between gold and silver is being driven by a temporary force, as the report suggests, then the next question becomes obvious. What happens to silver once that force begins to fade? To answer this, the researchers turned their attention away from central bank vaults and towards something far more fundamental: the physical supply of silver itself. According to the Silver Institute, together with the research firm Metals Focus, the silver market is now in its 6th consecutive year of a global supply deficit. In simple terms, this means the world is consuming more silver each year than mines are able to produce. This is not a short-term imbalance caused by a single disruption. It is a persistent, multi-year pattern, and it points to a market that is quietly tightening beneath the surface, even while headline prices remain calm. Part of this rising demand comes from silver's growing role in modern technology. Solar panel manufacturing, grid electrification projects, and the expansion of artificial intelligence hardware have all increased the industrial need for silver in recent years. Silver is not simply a monetary metal sitting in vaults. It is a critical material woven into some of the fastest growing sectors of the modern economy. The report does note one important nuance here. Demand from solar panel production has started to decline slightly, as manufacturers adopt a strategy known as thrifting, reducing the amount of silver used per panel through improved efficiency. However, this decline has been offset by rising demand from other industrial applications, keeping overall industrial consumption strong. On the supply side, the picture looks very different. Mine production has remained largely flat, unable to meaningfully expand in response to rising demand. Unlike gold, which is often mined as a primary target, a significant portion of the world's silver supply comes as a byproduct of mining other metals, such as copper, lead, and zinc. This means silver producers cannot simply increase output in response to higher prices the way producers of other commodities might. The result is a structural bottleneck, one that has been quietly building for years, while most of the market's attention remained focused on gold. This is where the report's most important conclusion comes into focus. Periods where the gold-to-silver ratio strays far from its historical center of 59.8 to 1 are not evidence that the relationship has permanently broken. Instead, they represent extreme market disequilibrium, a temporary mispricing that history shows tends to correct itself, often with force. And when that correction happens, it rarely stops neatly at the average. It tends to overshoot. History offers a consistent pattern here. When investment demand eventually shifts from gold towards silver, whether driven by central banks slowing their gold purchases, retail investors chasing higher potential returns, or institutions recognizing how tight physical supply has become, the ratio does not simply drift back to 60. It has historically overshot well below that level, falling toward 40, 30, or in extreme cases, even lower. The report is careful to note that today's environment is somewhat different from past cycles, given the unprecedented scale of central bank gold buying since 2022. This means a full return to the deep compression levels seen in past decades may be less likely in the near term. Still, even a partial reversion toward the historical average would represent a significant repricing of silver relative to gold. None of this guarantees that silver will rise sharply in the immediate future. Short-term volatility and macroeconomic noise will always play a role, and the report does not claim silver is currently undervalued in any absolute sense. What it does show, through more than 3,000 years of history and 56 years of rigorous data, is that gravity in this market has never truly disappeared. It has simply been temporarily overpowered. And when the forces holding it back begin to fade, history suggests that gravity tends to reassert itself, often faster than anyone expects.